season of giving is upon us, with many of us choosing to donate to our favorite charities. Despite an uneven economy, charities did see nearly $600 billion in donations last year. So people do still want to give and make a difference. If you are thinking of donating before the end of the year, financial instructor Michael Mazarant from the Retirement Education Foundation is here. He's got strategies to help you make the most of your donations, because yes, you want to be altruistic and donate, but also you could get a little benefit out of this too, right, Michael?
For sure. Now, we recognize that people do not give to charity for the tax benefits.
Right.
But if you put your tax planning hat on, you can you can do both. You can give to charities that you want to support.
Okay.
And you can also get tax benefits at the same time. And those extra dollars that you can save in your pockets, you can give even more to charity if you want to. You can spend more on yourselves, save more for retirement. There's a lot of ways that you can do good for yourself while also doing good for others.
Makes sense. Okay, so first of all, you have to figure out which ones are qualify, right?
For sure. So there are a lot of different ways someone can give to charity, and this is where things can get tricky. So, for example, we have on the screen right now qualified charitable distributions, or QCDs for short. This one is only for people who are age 70 and a half or older.
Okay.
So typically, if we're 70 and a half or older, what you can do is you can donate to charities directly from an IRA. Now, that might not sound too intriguing at first, but when you give money to a charity directly from an IRA in the form of a qualified charitable distribution, QCD, you don't pay taxes on that money. So now you're getting money out of your IRAs, and you're not paying taxes on those dollars, and those satisfy your RMDs if you're age 73 or older.
What's the RMD?
Required minimum distribution.
Right.
So a lot of people are being forced to take out taxable income that they may not need in their 70s, 80s, and older.
Okay.
You can give that money to charity, and you don't pay taxes. The charity doesn't pay taxes. That's a very powerful strategy. Another thing that someone can do is they can donate stock. So if someone has highly appreciated stock, if someone bought Apple back in 2000, and if they sell that stock, they'll pay a lot of capital gains taxes.
Yeah.
So they can donate that stock directly to the charity. They'll get a tax deduction for that donation, and they don't pay taxes on those capital gains from the Apple stock.
Now, can you donate that stock to a family member?
So you can gift that stock to a family member, but they will pay the capital gains when they go to sell that stock.
Right.
So with the charity, the capital gains taxes go away entirely because the charities don't pay taxes, and you get a tax deduction for that. And the third thing we have on the screen there also is, and this is becoming very, very popular, donor advised funds, or DAF for short. So what a donor advised fund is essentially like a personal charitable giving savings account. So instead of giving maybe $1,000 a year every single year to a charity, you could donate $5,000, $10,000, $20,000 of, again, highly appreciated stock into your own personal donor advised fund. You get the tax deduction in that 1 year, and you can give to your charities of choice as frequently as you want, for as long as that money lasts from that donor advised fund account. So essentially, you're bunching your gifts and getting the tax deduction all in 1 year, instead of getting a small deduction or no deduction over the next 10, 20 years.
Okay, so that fund you create with your stocks or your investments.
Yep.
And then because you might be saying, I'm not going to donate that much this year.
Exactly.
That's what you're saying.
So some people are giving $500, $1,000, $2,000 per year, and they may not get tax benefits for those smaller donations.
Right.
But if you bunch the donations all into 1 year in a donor advised fund, and then give your donations from that particular account, now you're achieving your charitable giving goals and getting tax benefits from that account at the same time.
And I know there's a lot of variables, but is there a certain number, is there a dollar amount that you have to donate to see a tax benefit?
So it really comes down to if someone's itemizing or not. Under the previous tax laws, roughly 95% of people were not itemizing, meaning those people were not getting tax benefits from charitable giving. Under the new tax laws in 2026 going forward, we're expecting to see that number drop to roughly 70% of people who are taking standard deductions. But still, it'll be really important, and this is why it's so important to plan. Because a lot of people, and I get it, a lot of people are just kind of giving donations willy-nilly, and it tends to pop up more in December. About 1/3 of all charitable giving happens in December in the holiday season. But if people are taking a step back and really planning out their finances, this is when you can take advantage of these charitable strategies, again, to save more tax dollars, put those dollars back in your pocket so you can do more good with those dollars if you want to.
All right. Do your research, keep the receipts, all that stuff. Good stuff, Michael. We'll see you next hour. Next hour, we're going to talk about talking to family about finances. It can be an awkward conversation.
It can be a little tricky, but it's really important to avoid any headaches down the road.
Yeah. So Michael's going to tell us how to navigate that. Thank you. Website refedu.org.
Yep.
Now this.